what is the meaning of trading for you?
I'll keep it with myself and then trade my own capital. We try to do an alpha of 8 to 10%. Our methods are very secretive. So,
How did you achieve this benchmark?
you should be very good at math. For example, Jim Simmons had a 63%. You should be good at coding. Our methods are very secretive. So,
Alright, so another episode of Not Another Trading Podcast. और ये एपिसोड थोड़ा स्पेशल है क्योंकि आज एक ऐसे टॉपिक के बारे में हम बात करने वाले हैं जिसके बारे में ज़्यादा कंटेंट आज अवेलेबल नहीं है. आज के जो हमारे गेस्ट हैं वो है मिस्टर कार्तिक जोनागडला. अगर कार्तिक सर के बारे में बताऊं तो ही इज़ द MD एंड CEO ऑफ क्वांटेंस रिसर्च. इन्होंने मास्टर्स इन फाइनेंशियल इंजीनियरिंग किया है फ्रॉम वर्ल्ड क्वांट यूनिवर्सिटी USA. अभी अपने आप में एक ऐसी क्वालिफिकेशन है जो बहुत कम लोगों के पास होती है. कार्तिक सर इज अ क्वांट एनालिस्ट, अ क्वांट ट्रेडर एंड ऑनेस्टली मेजॉरिटी पॉपुलेशन की तरह मुझे भी इस स्ट्रीम के बारे में बहुत कम आइडिया है. So मैं तो बहुत excited हूँ and if that sounds interesting to you, let's get started.
Alright, so hi Karthik, welcome to another episode of Not Another Trading Podcast by Stocko, previously that's on live. And आज हम बहुत सारी बातें करने वाले हैं quantitative analysis of stock market के ऊपर जिसके आप expert हैं. सबसे पहले how are you?
hi Ants, thanks for the invite. Great to be on your show. Just a normal market day and the evening and get along with you people.
Perfect. So we're going to talk a lot about quantitative analysis, and this is a very new concept. Okay, not a lot of people know about this. So I want like some great insights from you. But before we start, okay, there are so many people who don't know much about this. As I said, quantitative analysis is not everybody can do. Majority of the population, I can see, they are either technical analysts, or if they have degrees like CA or CFA or FRN, they go into fundamentals. So before we start, before we go deep into all these analysis and your journey and your trading style, can you just tell me what this quantitative analysis really is? Like if I'm a person who don't know anything about it, how can you explain this to me?
Quantitative analysis, this is a different breed of analysts out there. So who heavily rely on computers and then mathematical models for their analysis and the work they do. Very much similar to technical analysis, but more sophisticated version of it. So in technical analysis, like you have indicators like moving average, EMA, etc., based on which few people trade. But in quantitative analysis, it's more on mathematical models and then does this analysis hold true. So, and the basics of quantitative analysis is basically three things, like where you say if the market is sideways, trending, or say mean reverting. So if you can get one of these three right, then you'll kind of say like design better systems.
All right. So this is basically like, math-based analysis as much as I can understand. Like, how did you start it? Like, this is not a very popular stream. Like, if you want to become a trader, usually, as I said, people go with technicals or maybe fundamentals. How did you got to know about this? And how are you in the top? I can say 0.1% of quant traders. Like, how did you achieve this benchmark?
Okay, so my entry into quantitative analysis was entirely like fluke. Like it happened by chance because my hiring manager was looking for someone from a different industry so that like he or she can design a better quantitative system. So the basic problem in this industry is like lot of people have their own inherent biases. So to remove that bias, you rely on people like who don't have any knowledge about capital markets. That's how I got my first breakthrough. And after I got my breakthrough, so I built on whatever I observed and I learned. And then from there, like it just worked. Like so once you get a grasp of like what the things are, so you understand it. And I also add strength and statistics and coding, so which are two of the most important skills quantitative analysts should have. So that helped my case. But more than that, the thing like which me helped me the most was coming from a different industry, so which kind of helped me a lot.
So your hiring manager, you're talking about the hiring manager, and he
Yeah.
was finding the person from the different industry. So what company like you're going to?
So before this, I was working in an HR outsourcing firm, which is called
Okay.
Ion.
Okay.
So and from there, I transitioned to Motilal Oswal. So this was my transition. So from doing statistical analysis in the HR outsourcing domain to capital markets.
So the big firms like Motilal Oswal are also, hiring quantitative analysts. This is like, can we say this?
Yes, most of the firms today do hire quantitative analysts out there, because if you look at it, more and more people, more and more, volumes are driven by systems and computers.
Correct.
So, and quantitative analysts are the ones like who are best equipped to design such systems.
Right. Okay. So you have shared about your work experience, and with all companies you have already worked. And to become a quant analyst, you have done 2 years of masters in financial engineering from World Quants University, right? Which is one of the most prestigious university. And this program is itself like very very difficult. And I've seen very few people who have completed this program successfully. So, what was your overall experience and your overall learning from this program?
See, when I applied for this program, I already had 4.5 years of experience while working. Right, I always had this thing that like my basics are not that great, so I'll have to get back to the basics and build a strong foundations, and hence like I'll have to know more about this field. So that is how the intention of doing masters in financial engineering occurred. So, and while I was researching out there, unfortunately in India, like there are not many colleges or universities, so which is offering same kind of program. So,
Yeah.
and of all the universities in US, only one World Count was completely free, and I could pursue it along with my day job. So I usually used to like spend say 6 to 7 hours like after my office for a WorldCon program, and so that flexibility in timings. So that kind of allowed me like along with weekdays. Then like I used to put in some effort in the weekends too. It made me much more flexible to choose this program, and I could also self-pace it myself. So all were pre-recorded videos, so I can play it anytime I want, and I could pause it and then rewind it and then play it again and then learn the concept. So which kind of helped a lot. And one more thing which helped me was since I already had 4.5 years of experience, right, and having seen how the markets behave, so I was able to connect to whatever concepts which were taught, and I could quickly relate to this is what they're teaching, and this is where I can apply it. So I used to apply it immediately, like the next day, and I used to try back testing it, and so that's how like I learned.
So we're going to talk about the institutional trading styles and all. Okay, for sure we're going to talk about that, and I want to learn those strategies from you for sure. But before that, as you just mentioned, okay, this is how your journey was. How to get the admission in World Quant University. So what do you suggest for all those people who are aspiring to become a quantitative analyst? What do you suggest? Like, what should be their way of what should be their approach, and what are the necessary skills that a person should have or should develop in order to get admission in those universities?
There are multiple skills like which is mandatory, but some of them are say you should be very good at math. So you should understand math better than others. So that is,
So majority of the population is already out now. What next?
yeah. So, and apart from that, you should be good at coding because whatever you learn, right, you should be able to implement it, and then you should get an output very fast, basically. So you should know how to code then. And third, you should know a little about markets, at least the fundamentals about markets. So what are the instruments available? So for example, like in India, short selling is not possible. So if you're trying to apply whatever you learned from the West, so it might not work. So you'll have to understand the basics of the market. So that is one thing. And and mostly like it is the engineering nerds who get into such fields. So
All
because
those IT people having, masters and geniuses and all those people.
yeah, because these are the people who are already exposed to such ideas in their engineering, and most
such
of it
maths.
is even the math too. So
Even math.
so whatever you learn is more of an extension of what engineers do in fields like industrial engineering, so where optimization is taught a lot. So you can apply most of the quantitative finance is also around optimization. So in a way, like if you have a background in industrial engineering, that is going to help, like, or aerospace engineering, etc.
Okay. So any commerce degree is suitable to become a quant trader or quant analyst?
I've known 2 to 3 people personally, like who are good quant traders, like despite coming from a commerce background. So because they put in the effort to learn to code, and then and learning the math behind it. So learning is the only way through which you can definitely achieve anything that you want.
Got it. So, okay, how is clear? Okay, it's like how we can do, and what should be the ideal way and what should be the ideal degree and skill set. Now the question arises is why? Why a person should become a quant analyst, and particularly when you talk about in trading world, a quant trader. Okay, how is it different, or what is so magical about this that people should try to become quant traders, try to understand what all these things are. I mean, technicals are working fine. Fundamentals are also working fine for so many people. Like, the biggest investors in the world, like, Warren Buffett, he's a fundamental analyst, right? Okay. One of the biggest investors in our country, Rakesh Jhunjhunwala, he's a fundamental analyst. They do value investing. Like, what is the difference and why we should go for quant analyst?
See, the thing is, right, like be it fundamentals or technicals, there are multiple people they try to apply the same methods. So I call it the herding philosophy. So when a lot of people try to do the same thing, right, the ability to create alpha decreases with time. So you should come up with new methods to find that source of alpha. Whatever everyone would have read those same books. So how are you going to further differentiate yourself? And one more thing is that it is basically supply and demand. Today, there is high demand for quantitative analysts, whereas the supply is low. So in a way, that also helps for people to get into such roles.
Okay, so even if you're pursuing a job, like if that is your aim, even then it's a good option, right? That's what you suggest.
See, a lot of people, right, they do quantitative, say a program like financial engineering, and they get into a lot of risk management domains also, because risk is something which is not taken very seriously. Whereas if you look at large institutions, so they allocate, say, good amount of resources and time to mitigate the risk. So, and a lot of people don't understand this metric well, like how to do this, and that's the reason you have a specialized program like FRM, which is purely for risk management,
Yes.
which is out there. So and this is one more field like which is growing very fast, so which again offers opportunities. So people
Correct.
who understand these things better, right? They design better systems. It's a very simple thing. So know it, and then you'll be able to create a better system. I'm not saying that technical analysis and fundamental analysis will go out of favor, but there are enough people out there, is what I would say. So
Yes.
for you to make a new in this competitive space, and you are looking for your breakthrough, and if you happen to be an engineer, so quant analysis is the easiest transition which one can go through if you are from a different.
Really?
Yes, like I told you, right? Engineers are better equipped than anyone else. So, and it's all about you understanding the concepts. So, irrespective of it being any field. So, if you, a lot of people, right, they spend time doing courses like CFA, etc., which is not actually required for you to get a job
Come on,
in this.
don't say this. I am pursuing my CFA, man. Come on, you can't say stuff like that. I'm already
No,
demotivated.
I'm not saying that. CFA is mandatory for quantitative analysis. If I am the hiring manager, right, I will not look at your CFA degree or something. What I look at is do you understand math, and do you know how to code? These are the two basic things. And if you don't know anything about the markets, this is the best thing to happen to me. I'll hire. So these are the three criteria which I kind of have as a hiring manager.
So that's why I should never apply for a job. God bless. So, well, as you suggested, okay, for engineers, especially, or people from science and math background, it won't be a very drastic shift. It will be an easy shift for them, right? But as you suggested, okay, there are so many people who are doing technical analysis and so many people doing fundamental analysis, and you should know something new or something better in order to make better returns. So when we talk about better returns, or when we're talking about making a career out of it, what kind of returns are we talking about? Let's say if I'm a technical analyst, 18% a year. So as a quant analyst, how much will you make, or what will be your alpha?
See, as far as we are concerned, we try to do an alpha of 8 to 10% for the benchmark. So through our investing methods. So this is what we try to add as cons out there. So and different people have different ways to approach this. For example, Jim Simmons had a 63% annualized CAGR for 30 years continuously. So, and it is all about the mastery which you have in the field. And so the more mastery you have, the more is the ability for you to have to create more alpha. It's what I would say.
Okay, that was a diplomatic answer. I just wanted to know a number, but okay, if you don't want to tell me, that's okay. So, fine. You don't want to tell me the number, you don't want to tell me the percentage. What is your highest profit that you have made in one single trade?
See, it depends on the capital out there. So typically, we try to, we are more interested in the reward to risk ratio. So which we wanted in the range of more than 1.5. So beyond 1.5, higher it is, the better it is for us. So this is one metric. So and it is something to do with your position sizing also. No matter how much capital you bring in, so what is your amount which you are allocating. So it's a mix of multiple things. So but having said that, we typically aim for say 1.6, 1.7%. If at all we lose 1%. So this is what our ratios look like.
That is your risk reward ratio, right? 1.6.
Yeah.
Okay. That is in trading, right? Not in investing, because in investing, of course, it's much bigger.
Yeah, in investing also, it's the same number for us. So 1.6, 1.7. So we try to keep it beyond 1.5 for our systems to make sense. Otherwise, you'll keep losing money in the long run.
And what is the success rate of this entire analysis?
So let me just give you an example. So
Sure.
in quantitative analysis, right, it is always about expectations. So say if you have a system like which makes 1 rupee with a 50% probability. So 1 into 0.5 is 0.5. And if you lose 1 rupee with 50% probability, so
0.5.
again 0.5. So 0.5 minus 0.5, 0. In the long run, you're not going to make anything. So
Correct.
for example, like even if you have say a winning probability of 40% and say a system like which is 1.5 and a losing probability of 60% and you lose 1 rupee. So still like you'll make nothing. So for you to start being positive, right, you should look to be beyond 1.5. So, and I'm taking a very conservative number of say 40% winning. So, very conservative number. So that is the reason we typically try to get it right, say 60% of the time. So, so I always build the worst case scenario and then try to take it forward from there. So in the long run, your system should be able to make money. So, and that is the reason why probability and reward to risk ratio is like really important when it comes to say systematic trading, quant trading, whatever it is.
Correct. Okay, so what you're saying is your risk to reward and your success rate should complement each other, and that's how you can be profitable in the long run. By the way, if you guys don't know about risk reward position sizing and what Mr. Karthik is talking about, we've already made the entire series on this stop loss position sizing and risk management. You can check it out on this channel. So, and one more thing, as you said, you're being conservative and saying 40% success rate, and you try to achieve 60% success rate. Well, Karthik sir, there are people in the market. Okay, let me tell you, I am not sure if you're aware of that. Well, Karthik sir, there are people in the market. I'm not sure if you're aware of this. They are selling 95% accurate strategies for 30,000 rupees only. They are ready to give you their indicators for 5,000 a month. What is your view on that?
I'm not going to question the authenticity of such gurus if they exist and if they're offering it at 30,000. So you'll have to ask a question. So why are they offering it at 30,000? If I have something with 95% accuracy, right, I'm not going to sell it as a course. I'll keep it with myself and then trade my own capital. This is what I would do.
What they've done is they have made the money that they wanted. Now they want to spread this to other people. They want to help other people, and they want to make them self-sufficient when it comes to finances. That's why they are doing it out of their kindness. You're not understanding it. And you are still stuck with your 60% accuracy.
See, if people today ask me to divulge my strategies which makes say 60% accuracy, I still don't share it. So if I'm not sharing it so there is a reason behind it. So and I'm successful. So you may not always require a 95% accuracy as a trader to make money in the long run. So even with say 40% success rate, right? So you can make money provided you have a disciplined approach towards trading. So trading is more about say mindset and how you approach it rather than this trying to make a trade out of everything.
So you don't have your course, you don't have your own classes, your academy or something?
See, we have our methods are very secretive, so we prefer not to teach. Our funda is very simple. So if I teach it to everyone, then I will lose the alpha like which we are generating. So we don't teach it.
But are you really a trader if you're not teaching your strategies?
It, I I usually don't trade. So we do quantitative investing, which is more like say short-term positional cash calls. So that is where we kind of say, survive on.
Okay, so as we mentioned, if you reveal your strategies or if you reveal the system by which you trade, it might not generate alpha for you, right? And this is basically covered in a theory called efficient market hypothesis. By the way, I learned this in CFA because you were not supporting it, but I learned this in CFA. So efficient market hypothesis is something which says that if one strategy or one way of investing or if one information is passed to majority of the population, then that system, that strategy or that information won't make any great returns for you, won't make any alpha for you in the market. This is what that my hypothesis suggests. But I have this one small question. Let's say I have a strategy that I will buy when I will very simplify it. I will buy when the market or when two moving averages are giving a crossover. Let's say 9 moving averages going above 20 moving average. Okay, I will buy above that. So if this is my strategy, and if majority of the population know about it, and everybody will also buy on the same crossover, don't you think that will actually create the demand? It will create a mass demand, and it will actually take the price up. Don't you think that will happen?
See, we personally don't believe in efficient market hypothesis, to be frank. So, for example, like today's, over the last few days, you see this news coming out that HDFC Bank might see a increase in weightage in MSCI weightage, in MSCI indices. So basically, if you see in such a scenario, right, what happens is that it is more something to do with fund flows. So the MSCI India index has a certain AUM which is being tracked. So and whenever there's a weight increase or decrease or addition to the index, removal from the index, you know that this much supply or demand will get created, because of which you kind of pre-position yourself. So, and this is one of the common trades which large institutional desks do. For example, we used to do for MSCI flows, CPSE flows, baare 22 flows. So all these, right, you can kind of predict it, and then there will be a certain buying pressure, selling pressure. So, and you can take advantage of it. So, and everyone has the same information, but only few people take advantage of it. So, and which makes me believe that markets are not efficient. So, there is always an arbitrage opportunity. And if you look at it, there are a lot of arbitrage funds also out there, which try to do some statistical arbitrages, price arbitrages, everything.
Correct.
So all such arbitrages is exploiting market inefficiencies in a way. So I personally don't believe in efficient market hypothesis. I don't find much sense in it. So I would say that's more of a academic concept.
Yeah, so if more people know about it, it's better, no? That's what it suggests, right?
See, more people will know about it, but only few people will exploit the information.
Yes, you will act upon it and will use it up.
Yeah.
Correct. Okay, so efficient market hypothesis is something in which you don't believe. And are there any other, common beliefs or, myths, according to you, which majority of the population believe, according to their analysis, but quants or quantitative analysis don't believe in those things?
I cannot talk about the entire quantitative analysis community, but me, I don't believe in all this, people talking about 5-year average PE ratios, etc. So, for example, I'll just give you an example. If you look at world GDP, right, typically it grows every year. So if you
Yes.
keep comparing it, like, and if you draw a graph, like it is going to be here. So now, like, are you going to say like it is over? I mean, the GDP is
Overvalued.
like
Yeah.
overinflated. If
Yeah.
it's going to come down. So your graph, I mean, your say like say your graph is like this, like now, like it will keep moving that window. So
Correct.
whatever charts which people show, right, with that nice curves and everything, they're fixing a window, basically top and bottom, and then they're showing. Obviously, like when you're at the top, like you'll say that like this is at the top and this is the bottom. Visually, you know it, but do you know like this is the exact top out there?
Correct.
Is the question like which I would like to ask. So what I would say is that like before you make such statements, like you'll have to establish a property that it is mean reverting. So in quantitative analysis, right, there is a property like which is called mean reversion. So when you which basically means that it will go back to zero or like negative. So
Correct.
so you'll have to establish that property. So once you establish that property and then you talk about it, then it makes sense. But just because a number looks inflated, like you cannot say that it is overinflated or something. For example, your age increases with every passing year. So you cannot say that like it's going to decrease. So you'll have to find a property like which is mean reverting. That is what I would say. So without that, like you cannot talk about all these averages.
Okay, so you talked about mean reversion, right? And I have this one issue with so many different type of analysis and so many different type of methods that we have. Hey, if you say that HDFC Bank is going to go up, if let's say you are saying HDFC Bank is going to go up, okay, we are not recommending any trade. Let's say you are just saying HDFC Bank is going to go. It will be reflected in my chart. It will be reflected in a line chart or a candlestick chart. It will be reflected in all the indicators that are there. It will be indicated or it will be shown in your quants diagram or whatever numbers that you see. And of course, if such a big company is going up, it will be reflected in the fundamentals as well, right? So if all the types of analysis are showing you the same data, almost the same data for the same stock, and giving you a bullish signal about it, okay, it is just a matter, or is this just a matter of when do you enter? Like you might enter 2 days prior to me, or I might enter like 4 days after you've already entered. I think this is the only difference, right? Like, is it making sense to you?
I do understand where you're coming from, but if you look at most of the, hedge funds out there, like, so they rely on a strategy which is called long short. So which is nothing but relative returns. So they take long in one stock and they short another stock. So, and they opt for a relative performance. So as cons, right, like we typically do this like most of the time where we are kind of betting on relative performance rather than looking at stocks as a silo. So for us, like it's not only about a stock like HDFC Bank. It's also about like what you're adding along with HDFC Bank, which matters. So for let's say like you're just selecting 10 stocks from top 50 names, like Nifty 50 names. There are 1,027 crore ways of picking the combinations. So for a human, right, this is really difficult, but machines can do it very quickly, and they'll optimize and they'll give you like which stocks like it should be on the long side, which stocks you should be on the short side, and that is how like most of the hedge funds also make money, like through relative performance of these stocks. So which is basically like market neutral strategies. So where in a bullish phase, like if you buy a stock which goes up by 10% and if you sell a stock which goes up by say 6%, net you are making 4%. Similarly, in the in the say bearish phase also. So this is something like which most cons focus on, like relative performance is something where they generate the alpha mostly. So it is not say a singular silo kind of a stock where like I'm focusing only on HDFC Bank. So you can do it, but we don't do it.
Okay, so basically, getting the combo, getting all the permutations and combinations, and then, getting the coefficients and, the R's and all the statistical data, and then, getting little bit secured returns from the market, right? This is what you're suggesting. Perfect. So, okay. So, well, we've talked about all these things, and, and you are a professional trader. You have traded with institutions. You are trading with institutions, right? So, I want to know how to trade professionally. Like, what are those skills? What are those habits? Or, what are those traits that you should have, or that you should develop to trade professionally? Of course, you will say, okay, you have to become quant trader. I don't want that. Okay, that is too difficult for me. But for a normal person who is trading, or maybe investing, maybe doing options, or maybe doing swing trading, whatever, what is that skill they should have? What are the habits they should develop? What are the traits they should develop?
So some of the traits which I believe are essential is patience, practice, and simulations. So when I say patience, so this is a thing like which most people lack. Like, they are not patient enough to for the strategy to mature. So I mean that is the beauty of you having a say systematic approach or a quantitative approach. Like you have a strategy. Like how long will it take to mature. So do you have the patience to follow it? And you should worry about, like, say the trade before you enter into it, not after you enter, because we should always focus on like what is the probability of winning, reward to risk. And apart from this, like we also look at like what is the average maximum upside which we had seen in the past for a particular strategy, and the average maximum downside. So if your entry conditions were good, like you shouldn't bother much. Like, so one thing definitely is say patience, and second thing is practice. So I mean, without enough practice, right, you won't be able to master that art of patience. So and if you are starting, like start small. So I mean, put only a very small capital at risk, like instead of putting the entire capital at risk. So
Test the water.
Yeah, test the waters. Yeah, basically that is what I'm trying to say. And third is simulation. So again, this is a risk management concept. So see, let me just explain. So we use two methods. One is it might look like a very complicated topic, but no, it's not complicated. So we use two methods: Monte Carlo simulations and historical simulations. How do I know like what is the maximum drawdown like my system can show? So I simulate the forward path, assuming certain conditions. So and I see like what were the worst 5% returns, like which it printed. Basically, we call this tail risk. So what is the worst negative extreme returns which it showed? So that is something like which you can generate it using Monte Carlo, which is a forward simulation approach. So, and few people argue that like, okay, in forward simulations, you are assuming few things and you are building your equations. What if your equation itself is wrong? Okay, wonderful. Yes. So that's a valid question, right? So you are like, instead of we building an equation, say for example, like we know Nifty had as a history like right since like 1992, 93, you will get the data. from the exchange itself. So pick randomly any given day, and repeat this process again and again. So what is the worst say daily returns which you had seen? So your system will typically build a scenario. Like you'll have to do this multiple times, say 1 million, 10 million simulations. The more simulations you do, more data points you capture, and that is how you kind of build expectations as to what is my worst negative extreme scenarios, which I call it the tail risk. So
Correct.
is it contained? So if you can contain this, try to minimize it. So you cannot obviously eliminate it. You'll have to try to minimize it. So if you can minimize it, so you have a good system in place. So basically, simulations is something which I recommend people do it. Simulate your trades, or you have the benefit of all this historical data. So simulate it and see how it behaved in the past, how it behaved in stressful periods. So that is something which So, but for you to build that systems, obviously you should know how to code. But that is the reason why coding is important.
Right.
Modeling is important, mathematical models. So building that equations is important.
So to simplify this, now what Karthik is saying, that you look at the historical data, and using that historical data, you use your models to, in a way, forward test it without actually forward testing it. Using the model, you simulate the entire situation, and in a way, you forward test it. And by that, you get an idea okay, what is the worst thing that can happen, or what's the worst case scenario, and if you can handle that, then you're good to go. Right?
Yes.
This is, I think, what the entire simulation thing actually means, right?
Despite doing all this, we have accuracy of 60%. So
Still, you're lagging behind. No, 95 is still so far away from you, dude. Anyways, so of course, you don't have the 95% accuracy, but even with 60% accuracy, can you tell me what is your total asset under management?
So right now, in our quantitative investment strategies, we are doing about anywhere above north of 100 crores.
100 crores.
Yeah.
Okay. Yeah. And generating around what type of return? As you said, 8 to 10% alpha.
So so we typically target this range of alpha. So depending on the index you choose, so we try to do 8 to 10% over the index. So that is when we'll be able to justify our research agent.
तो भाई साहब 20 करोड़ रुपए बन रहे हैं साल के. This is the simple calculation. That's great, sir. Now, see, for a lot of people who are trading, they want to trade, or they are learning to trade, or they want to become a trader, trading can be different for all of them. But for a person who is from a completely different background, science background, and accidentally got into quants and then into trading, and a person now who is handling crores of rupees, what trading means to you today? This is a little bit philosophical. This is a little bit about your own view and your own feeling, not about the quants. But this is what I want to know. I ask this question to a lot of successful people. What is the meaning of trading for you?
For me,
Today.
the meaning of trading today is I can go to sleep knowing that my negative tail risk is minimized. So in case of a very drastic event, I know my system will do a good job. At least 6 to 7 times out of 7 out of 10 times, I can sleep peacefully. So even if there is a very bad event happening, I know that my system can handle it because we are well prepared for it. So that is what today, what it means to me.
All right, Karthik. It was such a great pleasure having you here on this podcast with us. Thank you so much for all these great insights. Honestly, if I tell you, before this interview, before this meeting, I had absolutely no idea about what quants are. Heard about it, okay? And I know some people do it, but honestly, I never thought I'd be able to understand quants, and I never put any efforts to understand it at all. But today I got so many insights, and I'm really, really sure so many of our viewers might have got a good clarity about what quantitative analysis is and how, if they are interested, how they can pursue this field. Thank you so much for being a part of this podcast with us. If you have any parting words for all our viewers, please share this.
Thank you, Anj, for this wonderful podcast. So, my only opinion is that common sense works better than anything else. So keep it alive, and keep your reward to risk ratios and probabilities. Like, always keep it on back of your hand, and you'll mostly overcome most of the issues out there. So once you have say mathematical model built to it, you'll be able to overcome whatever it is.
Perfect. All right, Karthik, thank you so much. And as I said, it was an absolute pleasure having you on the show. Thanks a lot. And I will see you super soon for more such informative content for all our viewers. Thanks a lot.
Yeah, thanks, and see you. Bye.
ऑलराइट, सो वेल ये था पूरा पॉडकास्ट विद मिस्टर कार्तिक जोनागडला. एंड जो नई चीज़ें मार्केट के बारे में और क्वांट एनालिसिस के बारे में स्पेसिफिकली पता चली है, आई थिंक दिस इज़ वेरी इंसाइटफुल. एंड जितने भी हमारे न्यू ट्रेडर्स हैं जो नए तरीके खोज रहे हैं ट्रेड करने के, नए एनालिसिस करने के तरीके खोज रहे हैं, उनके लिए दिस कैन बी सुपर इंस्पायरिंग एंड सुपर यूजफुल. और अब इस सारी नॉलेज को यूज़ करने के लिए आपको ज़रूरत पड़ेगी एक रिलायबल ट्रेडिंग प्लेटफॉर्म की. एंड इफ़ यू लुकिंग फॉर वन, देन कंसिडर ओपनिंग एन अकाउंट विद स्टॉको, फॉर्मली SAS ऑनलाइन. अकाउंट ओपनिंग का लिंक आपको डिस्क्रिप्शन के अंदर मिल जाएगा. और मैं आपको ऐसे ही अगले इन्फॉर्मेटिव वीडियो के अंदर मिलता हूँ. टिल देन कीप लर्निंग एंड कीप ट्रेडिंग.